The history of indexes. The Philadelphia Stock Exchange was founded in 1790. Then in 1792, there was a crash in the U.S. government bond market. In response to the crash, a group of brokers gathered under a buttonwood tree in New York and agreed to trade with each other, which marked the founding of what later became the New York Stock Exchange. Prior to this 1792 market crash, there had been several earlier crashes, such as the famous Tulip Panic in Holland in 1630. It was not until the mid-1800s that people started to see a near-clockwork regularity to them. In England, there were market panics in 1804 and 5, 1815, 1825, 1836, 1847, 1857. Some explanations for these were things like sunspots that occurred every 11 years. By the early 20th century, versions of a rational market theory began to think that if people would use economics and probability theory in their investing, they would do better. But it soon became evident that investors were still not faring well in the market due to emotion, lack of logic, and an insufficiency of knowledge. In 1884, Charles Dow created what was later to be known as the Dow, which tracked 12 leading stocks, and in 1923, the S&P 500 was created. By the early 1930s, some people began to realize that if you mirrored the holdings of either of these indexes, your portfolio would outperform the average stock market guru or investor. The first index fund offered to the general public was not created until John Bogle, the founder of Vanguard, created one in 1976. In those early years, there were not many followers to this index type of mutual fund because most financial managers believe they can beat the index, even though history has consistently proven them wrong. The dark side of a recent study proved that when given a chance, 50% of financial planners would switch an investor to a more actively managed account because they pay higher fees, and only 6% would switch their clients to an indexed fund. Indexed funds have grown steadily since then. In 1990, the total equity in indexed funds was barely $1 billion. Today, it totals more than $559 billion. Jack Meyer, the former CEO of the Harvard Endowment Funds, said about normal investing, "The investment business is a giant scam. Most people think they can find a fund manager who can outperform the market. But most people are wrong. You should simply hold indexed funds. No doubt about it." The best index to own is found in an IUL, with its lock and reset, and the opportunity to gain all or some of the upside of market gains. It beats the return on any other index, given the fact that we have had 18 bear markets between 1929 and 2002, occurring approximately every 5 years and averaging a decline of 37.5%. During these cycles, the market has experienced some great up years, and if you can capture some or all of the gain and eliminate all of your downside risks, you will come out way ahead in your retirement fund. The Wall Street Journal recently reported that the top 10% of the richest Americans own over half of the tax-free investment gains built up in life insurance. I think it's fair to assume these people can afford the best attorneys and the best accountants. Do you really think they would be investing in something that is too good to be true? It's more likely they know something you don't. Maybe it's time you took a harder look at what an IUL can do for you. The 0% floor shields the client's indexed account from negative returns and leads to a much better outcome than if the money had been invested directly into the market. The index account has effectively lessened the effect of market volatility on growth potential.